Well, greetings to you. I just thought I'd tell you a few things about money. Money, currency, fiat currency, so on and so forth. Just a few words for a bit of background for those of you, and I know many of you who are subscribers know this full well, but it's more of a reminder and more of something for new subscribers. I thought I'd just run past you in an anecdotal way. Back in the late 1950s, as a sprog uh, in the village, running about, one of the things that people were buying for some reason was Toy Town money. It was fake money, it was fake notes. I suppose I was 10 years old or something like that, 9 years old even, maybe. And it felt, don't forget, we'd had pennies and halfpennies and sixpences. That's what we were used to. And we were never allowed, and we got near paper money. Daddy had, £5 notes and £10 notes, and occasionally, and so on and so forth. Pound notes mainly. However, we bought this, and he bought it in a cellophane packet. That was only a few real pence, but it made us feel grown up. And we had it, and we did actually exchange some things. Somebody could find somebody who had something that might exchange it. A chocolate, a wagon wheel, a gobstopper, or whatever it was in those days. I can't remember. 1958, 59, 60. And I remember my father finding it and cross-examining me, and he was pretty cross about all this. He said, what's this? It says at the top, Bank of Toy Town, not worth the paper it's written on. And this was actually written on the paper money. And my father said, why would you spend good money buying this? Doesn't make any sense. But of course, he hadn't fully understood the idea of a 10-year-old or a 9-year-old actually handling paper money and feeling grown up. That was really what the game was. But leaving that aside for the time being, it led him to give me my first lesson on the concept of inflation. Inflation, if you will, the degrading power of money buying goods and services. And he explained then to me, he was a businessman, a city businessman. He understood these things. And he said, just imagine here in our house that I tore up a newspaper, and we had lots and lots of bits of newspaper torn up. And that was our currency. That was our money, if you will. And we could exchange. You could exchange with your sisters. You could exchange it in and around the house. Your strip of paper, newspaper. Which would buy you, your sister's chocolate bar or something like that, because it would be an accepted form of monetary exchange. And he said, now, what's going to happen, for example, if somebody sits in the corner with another newspaper and turns it into even more strips? It will be the inflation of your currency. So your sister will no longer ask for one piece of paper for a bar of chocolate. She'll ask for two or three. And that's what happens when you get inflation, inflationary money. And funnily enough, all those years ago, I understood exactly what he was talking about. I understood it at 9 or 10 years old. And it's a problem, of course, today that politicians and bankers and central bankers and so on and so forth, and indeed most financial journalists, have no idea, because their father wasn't patient enough to sit down and tell them about inflation. Now, we got to paper money. How did we get to paper money? Well, it's a long time ago, and there's a lot of discussion about it, and not a lot of people agree where it started. Some people say it was right back in China, but I don't want to go down there because it's not a sort of a technical lecture per se. What we need to understand is that for thousands of years, money was gold or silver. And the Roman Empire collapsed in about 500 AD because they degraded their money. The silver denarius was degraded, and precious metal was sidelined in favor of paper. And of course, if you go back, certainly even into my youth, you'll find a £5 note. Will say to me, with the Bank of England on it, I promise to pay the bearer on demand the sum in gold of whatever it was. So in the 17th, 18th century, you could take that piece of paper into the Bank of England, and they would exchange it for gold, either gold coin or gold bullion. And the reason for paper was simply that it meant that you didn't have to travel difficult highways, footpads, and a poor transport system carrying rocks of gold amongst your person. So you stored it with a bank, gold, a gold storage facility, call it what you will, in those days, in the 1700s, 1800s. So it stopped you carrying it on the road. And that piece of paper was a promissory note. It promised that it would actually make it good in gold at some stage when you wanted it back. And broadly speaking, it did, broadly speaking. Wars come along and people go off the gold standard. Our country went off the gold standard in 1914 because it had to pay for war. And it's the same in America. They went off the gold standard, the famous Yankee dollar, in order to pay for the war in Vietnam. But the point I'm driving at here is that paper money is a promissory note. It's credit. And it's all right exchanging it for goods and services when people will accept it. But the more paper you print, the more devalued it becomes. And I've said this before, I'm going to repeat it again now if I can dig into my pockets. You bear with me a second. This is a gold sovereign. Okay? This is a gold sovereign. And this one happens to be dated 1908. And in 1908, this gold sovereign will buy you bed breakfast in a very good hotel in Paris or London or Berlin or New York. It was the pound coin of its day, would you believe it? It was the pound coin of its day. It would buy you probably in the region of 200 pints of bitter, for example, in a tavern, and all sorts of other things. And because you can't degrade gold because there's only a limited amount of it, and politicians and bankers can't print gold, it has to be dug out of the ground at some expense. That's how it worked, which meant inflation didn't happen when we were on that gold standard. And this gold sovereign, the concept of it was, let's take just post Waterloo, the Napoleonic Wars, 1817, 1818. The sovereign came forward, and the whole point of that was that it was used. It was used every day as a medium of exchange, or portions of it, so on and so forth. Which meant if you take the stable product, as it were, of the country in those days would be a loaf of bread. So from 1817 to 1913, before we came off the gold standard, a loaf of bread was didn't go up in value. You could buy it for the same value for all that long period, from 1817 to 1913. Because you couldn't have inflation because we were on a gold standard, and you can't fake it. Now, this little chap is a gold coin, and you will see how very close they are. They look the same. They're meant to look the same, to same sort of feel. But because this is alloy and this is gold, so this is intrinsically worthless. It only works if people are prepared to accept it in exchange for goods or services. Of course, a pound coin now buys you virtually nothing. It might buy you 1/4 of a pint of bitter. It will buy you almost nothing else. It's getting close to worthless. And even in my young days, a pound was fairly substantial. You buy a lot of tucker from the tuck shop for £1, believe me. You can't do that now. It's worthless. You need 5 or 6 of these in London if you want a pint. Appalling, but there we are. And if you come on to the stable commodity, perhaps, of the 20th century, you would argue it was oil. Now, this gold, the price of oil per barrel in 1900 was the same as it is today in gold, if you price it in gold. The price of oil hasn't gone up, and that's a stable commodity. I think you'll agree that oil is a stable commodity. Hasn't gone up if you judge it against gold. If you judge it against fiat currency or paper money or alloy money, of course, it's shot up. It's gone really high, of course, and we all know that, don't we? So that shows you gold is a preservation of wealth. It preserves wealth, not an investment. If you want an investment, you must invest in maybe equities, which are vastly overpriced at the moment or whatever. But it isn't. It's a store of wealth. So if you stash these away, they will buy you in 100 years' time exactly what they buy you today. And if you had a time machine and you went back, you would find that the same procedure would follow. It freezes your savings. It freezes it. And it protects it from inflation. And indeed, in certain circumstances, which I won't go into, but I'm sure you know how many beans bake 5, the Chancellor can't find it. When you've got it, he doesn't know you've got it. If it's in the bank or if it's in property and everything else, he knows you've got it. Now, there is an audit trail, of course, when you buy these chaps. There is an audit trail. And the audit trail dies away year after year after year. And if you give it to your children and over 7 years, it dies away without inheritance tax, so on and so forth. And you all know your own business. I know, because my subscribers, the reason they're my subscribers is because they're actually quite wick, as we say up here in Yorkshire. They're quite wick. So these are the points that I'm just making. And we know that the United States cannot sell treasury bonds, long-term treasury bonds. The world doesn't want them, and the world doesn't want gilts, which is the equivalent, of course, in the pound sterling, or euro bonds, which is the same. People don't want them because the capital value has been degraded. And if you buy a bond today at a coupon, say, of 4%, and they have to move the coupon to 5 or 6% in next year, which you're going to have to do to try and get the bond sales away, the capital value falls. So this is why some insurance companies and some banks in the United States have already gone broke, because they were holding what people thought was absolutely top stuff, i.e. T-bills, treasury bills on the Yankee dollar. And they've gone out, they've gone down. For the simple reason that as interest rates go up, capital values go down. Something that needs to be understood. So understand that. If you understand that, you can protect your family's wealth. Just keep enough money in the bank. Just keep enough money in the bank to pay your bills. What you don't need is too much money in the bank, more than you need in a bank, giving you a pathetic rate of interest which doesn't even match inflation, real inflation. Not what the government are telling you when they told you it was 3% last year. As any housewives who are knowing this will know that that's ridiculous, absurd, and lie. So you have to be really careful to protect yourself. It goes with all the other things that I think are coming down the road. It comes with a stash of food, tinned food, bits and pieces, so on and so forth. And security of your own home, which I'm afraid today, as you all know, is getting more and more apposite. Traveling on the train, how can these things happen? How can these things happen? But they do. So what I'm saying is, just be very careful about what you're doing and make sure that you're protecting your family as best you can. Don't bury your head in the sand.
And so, are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that.
It's most helpful, and then of course I automatically share it with you. So surprise, won't cost you anything. Thank you very much.